One of the more challenging aspects of the accounting cycle is closing out the temporary accounts, closing revenue and expenses into income summary, and closing owner's drawings directly into owner's capital. So let's do one together. First of all, here's the McGill Company. Their fiscal year ends on June 30th, 2014. We only close out our temporary accounts at the end of the fiscal year. So let's create a little income statement just to help us learn what's going on here. Remember, you can look at the bottom of the adjusted trial balance, and down here you see our revenue minus our expenses. $4,300 in revenue minus $3,500 in expenses gives us net income of $800. Don't be thrown by this payable that's hanging out down here at the bottom. Back when I learned accounting, back when Roman numerals were just called numerals, we did everything by hand on pieces of paper. And so if we were doing a 10-column worksheet to try to figure out what our adjusted trial balance would look like, and we discovered we had to accrue for some salaries and wages, we'd had to write that account down there at the bottom of the piece of paper. Nowadays, of course, we'd use Excel, and we just insert a row up here and put this liability up here where it belongs with his friends. Okay. So now it's time to close out the temporary accounts. To help you, I have 3 different ways that you might look at this. It might help you to think that this really isn't an account called service revenue. It's really called this year's service revenue. This isn't an account called salaries and wages expense. It's really an account called this year's salaries and wages expense. So when the calendar flips over to July 1st, 2014, and we start our new fiscal year at McGill Company, this number is really last year's number, and we want it to be this year's number. So that's one way to think about it. Another way that might help you is from the very first class, we said that the statement of owner's equity looked like owner's capital at the beginning plus net income minus drawings gives us owner's capital at the end. And so you might think that this step in the accounting cycle is where we finally put our money where our mouth is. We finally do what we said all along. We're going to add net income to owner's capital and subtract drawings from owner's capital. Or you might think our supplies expense, our salaries and wages expense, our miscellaneous expense are just 1-year buckets. So they're designed to hold 1 year's worth of expenses, and our revenue is designed to hold 1 year worth of revenue. And so at the end of the year, we have to take our buckets and dump them into income summary. So we take our service revenue with its credit balance and move it into income summary. We take our expenses with their debit balances and move them into income summary. And if we made money, the credit balance is more than the debit balance. And now these buckets are empty and ready to start keeping track of expenses and revenues for the next year. Regardless of how you visualize it, the debits and credits are still the same. Let's start with the revenue account. It has a credit balance of $4,300. If we want to make it 0, we're going to debit it for $4,300. And where are we going to put it? We're going to move it into income summary. We close our revenue and our expense accounts into income summary. So let's post that. Service revenue gets a debit of $4,300. Income summary gets a credit of $4,300. Do you see how we just took this $4,300 and moved it into income summary? All right, the expenses all have debit balances. So to make them 0, to empty out those buckets, we're going to have to credit them. And we're going to debit the account income summary for the total. So let's post those. Income summary gets a debit of $3,500. Salaries and wages expense gets its credit of $1,344. Miscellaneous gets its credit of $256. And supplies expense gets its credit of $1,900. Okay. So now we've zeroed out our service revenue, we've emptied that bucket, we've emptied this bucket, it has 0 in it, this has 0 in it, and this has 0 in it. And what is the balance in income summary? $4,300 worth of credits minus $3,500 worth of debits is $800, and that's our net income. Income summary is called income summary because it summarizes the net income. Now, since we made money, it makes sense that our owner's capital account would increase because of the money that we made. So sure enough, let's take this $800 credit balance in income summary and move it into owner's capital. So if it has an $800 credit balance, to make it zero, we're going to debit income summary for $800. And then let's credit owner's capital for $800. Now income summary has $4,300 worth of debits, $4,300 worth of credits. It has a zero balance. Income summary only exists for half a second and just allows us to empty our buckets into it of revenue and expenses and then move that directly into owner's capital. Finally, we have to start counting the owner's drawings over again. So if it had a debit balance of $628, to make it zero, to empty out that bucket, we're going to have to credit it for $628. And we close that directly into owner's capital. And that makes sense. If the owner took money out, they reduced their investment in the business. So let's post those entries. Owner's capital gets a debit of $628, and owner's drawings gets a credit of $628. So now owner's drawings, that bucket has been emptied out, and it's ready to start tracking the drawings for next year. And what's happened up here is we've had owner's capital at the beginning, plus net income, minus dividends, gives us owner's capital at the end. That's exactly what we've said from the first day of class. Owner's capital at the beginning, plus net income, minus drawings, I may have said dividends, I meant to say drawings, gives us owner's capital at the end. If we're dealing with a corporation, we'd be talking about a dividend account, and this would be a retained earnings account up here. Since this is a sole proprietorship, we talk about owner's drawings and owner's capital. And then the post-closing trial balance, all the balance sheet accounts would be the same, except that the owner's capital would now show a balance of 5932. The drawings account would have a zero balance, and all the service revenue and expense accounts would all have zero balances. All right, I hope that helps you understand the closing process. It's not that complicated. It's just different from anything else we've ever done before. So I hope that helps you guys out. See ya.